Hi, this is Ed Weinberg from CTRE Investors, and today we're going to be interviewing Matt Kelleher of Residential Mortgage Services. So, um, let me um, let's see. So I'm looking to see who's on. If you are watching on the replay, thanks for watching. So let me bring Matt on here. Um, okay. Hello, Matt. All right,
Hey there,
Matt.
Ed.
Why don't you tell us a little bit about what you do, what makes your company a little different from everybody else's, and then we'll start talking about the various programs you have.
Sure. So first and foremost, thank you, Ed, for having me tonight. My name is Matt Kelleher. I am with Residential Mortgage Services. We are a full-service mortgage lender based out of South Portland, Maine, with brick and mortar throughout the entire Eastern Seaboard. And in, I would say, biggest thing that sets us apart from other lenders is that we have a decentralized process and model here, where we have local processing, local underwriting. We have extremely quick turn times. And, first and foremost, what we do is mortgages, most importantly. That's all we do. So, we are, like I said, we are on extremely quick turn times. And we do have a lot of flexibility. If I need a same day, underwrite from my underwriter, I can certainly get that accommodated. I do have delegated processing and underwriting. So I do have the ability to get loans through very quickly if need be. So in terms of what we do, we have a full arsenal of mortgage products. And, there's pretty much nothing that we don't do from the lending side. So we are, we are here to help with all your mortgage needs. And, like I said, we have a full arsenal of products. So if you can, name it, we have.
Okay, you just disappeared. Your
Nope,
sound is okay. You're back.
I'm back. All right.
Okay,
So
everything
in terms of
arsenal. Yeah.
yes, so in terms of, I would say what sets me aside as a loan officer, I make sure that I'm always available for my clients. That's realtors, attorneys, borrowers. I'm always available. I've got a wife and a 2-year-old daughter at home, and even on the weekends, I always let my wife know. If we're in the car, we're going somewhere, the laptop's in the back seat, and if someone calls for a pre-qualification, we're pulling over. So, I do make sure that I'm always available. I know how important it is, with busy schedules, that a lot of times somewhat would be considered the most inconvenient times are the most convenient times for borrowers, for realtors to go look at homes, and I really make sure that I'm always available, to accommodate that. So, like I said, you can call me anytime, email me, text me. If I don't answer, it's only because I'm sleeping. But other than that, I calls, emails, and text to make sure that I can be there for you.
Okay. All right. So let's bring you back on, and I guess what we're going to talk about is the various programs you have and
Sure,
what the requirements are in order to get a loan. So I
absolutely.
guess the easiest one to get would be with I guess they call it a conventional loan. We're going to put down 20%. Is that what they normally want today, or?
Well, that's kind of the old standard is, with conventional, we could put 20% down, no mortgage insurance, nothing with any barnacles, if you will. But the model, thinking behind it's really changed. And conventional actually has a very competitive product now as well. We can go as little as 3% down with a conventional loan. Very similar to FHA. FHA has a little bit lower FICO score. With FHA, we would need a minimum FICO score of 580. Conventional, we can go as low as 600. So only a small difference there. With 3% down, as long as you have the FICO score, conventional loan is really an attractive product at 3%. Most importantly, because of the mortgage insurance. With an FHA loan, you have the mortgage insurance on there for the life of the loan. With a conventional loan, it automatically falls off at a 78% loan to value. Borrower can request cancellation once you receive that 80% loan to value.
Okay, and we've got a question from
Sure.
from Stephen Levy. Does Matt only lend in CT, or can he do MA as well?
Hey there, Stephen. I am licensed in Connecticut, Massachusetts, and Rhode Island, and working on a few others. So I can certainly lend in Massachusetts, and would be more than willing to help you.
Okay, great. And tell me, do you have? I think that you've got more offices too. So are there other offices in other states that they can go through RMS?
Absolutely. So any state that we are licensed in as a company, I can certainly, if I can't do it, I can take the application. And if I find out the bar is looking to go, originally they're looking at Massachusetts. I'm really thinking about New Hampshire. I can hand that loan off to a licensed loan officer in the state of New Hampshire. So yes, we do have offices and loan officers licensed in many other states. So not able to accommodate the loan. There are certainly people at the company that can.
Okay, and are there specific states that you know of that you can't do it, or can you do it in most of them, or how does that work?
We have a presence throughout pretty much the entire Eastern Seaboard into the Midwest. We do not, I would say, the West Coast. We're not licensed in California. We're not licensed in Texas. Mortgage companies that kind of have a big, license in all states and lend in all states, but don't really have a presence. And we really want to have brick and mortar, and a physical presence in the states that we do lend in. We do have a consumer direct department, which is licensed in many more states, which is fairly new to the company. So we do have the ability and are starting to have the ability to lend in some of those other states. But for the most part, we do want a physical presence in the states that we lend in.
Okay. So some other programs you have, I guess that
Sure.
was that the FHA that you mentioned before?
Yes.
That you
So,
3.5%
sure. A bit.
down?
Yeah, a big competitor of that conventional 3% down would be the FHA loan program at 3.5% down. Like I said, with FHA, you will have mortgage insurance for the life of the loan, and that monthly mortgage insurance factor is 0.85. With FHA, one of the main differences is there's also an upfront mortgage insurance premium of 1.75%, which is financed into the loan. So that does get rolled into the loan upfront, and then you have the monthly as well. And like I said, with the FHA, that mortgage insurance will follow you for the life of the loan. So it does not fall off once you reach 78% loan to value. That's on there for the full 30 years of the loan, across the board.
And let's see. I see we have Maya Lee is on, and Maya, you might tell us where you're from. I see we've got a like from Rich DePaul, and let me know if you're watching. Please give me a like so I know that you're there. Steve Levy, and mentioned him before. Okay, tell me, Steve has another question. He wants to know
Sure.
if you offer no recourse loans if you're to purchase a property with his 401k.
So in terms of non-recourse loan, Steve, what exactly are you referring to there? I apologize.
Okay, well, a non-recourse loan is a loan that you don't sign personally for. So if you're doing a loan specifically that's in your IRA, if for some reason you can't pay it from the proceeds of the property, you can't just pull money out of your pocket and put it in, because you're only allowed to put in a certain amount of money each year. So
Sure.
what the government, since you can't sign for it personally, the government makes you get a loan that they call a non-recourse loan. So you are not signing personally for it.
Oh, I understand. No, I apologize. No, we would not offer, something of that sort.
Okay, and I want to introduce Pierre Paul. I see that you just joined us online, and maybe you want to, I'm going to put you on, and you can tell us where you're from and what you do. Go ahead, Pierre.
Hi, can you hear me?
Yeah, I can hear you. I can see you.
Yes.
There's also someone else talking in the background. If you had a headset, it would probably be easier. But and without the light behind you, there we go.
Yeah. I'm, I'm a uh, uh, I live and work in Connecticut, Bridgeport, Connecticut.
Mhm.
Um, I'm basically uh, doing a lot of studying and looking to be an investor one day soon. Um, my main focus would be to start with house flipping, and I'm looking for a mentor or have a mentor to help me kind of guide me through the first step to um, to house flipping, and just basically just to get into the real estate investment business.
Okay, great. So I'm gonna pop you down below for a little while. We'll bring you in a little bit later if you have any, or if you have any questions, wave to me or say something in the lower right left hand corner. There's a probably or there might be a little thing so you can type a question or so. So we'll go. Lost myself, and we lost our guest. So I'll just wait for the guest to come. If anybody else has any questions, let me know. I see Danielle is out there. Danielle, nice to see you. Rich, we haven't talked in a while, and waiting for our guest to come back. And this is embarrassing, so I'll call him. Yeah, we lost you. You coming back? Oh, well, hang up and come back in because we seem to have lost you somehow. Not a problem. Bye. Okay. Yeah. So I guess this is first or second time that we've done this. And does anybody else have any questions? Or you know what I'd really like some suggestions on other interviews to have, things that you'd like to hear, things you'd like to learn about. And Matt is back.
Sorry about that.
That's not a problem. So Matt, you guys also do VA loans, I see.
We do.
Okay.
Yes.
Tell me how that works.
So with VA loans, excellent product for our veterans. It is only allowable for a veteran and a spouse to be on the loan. So they're very strict with that. With the VA loan, no money down. We can do 100% financing with that. And with a VA loan, there's also no mortgage insurance. They do have a funding fee for first-time use. That would be 2.14%. For subsequent use, that's 3.3. And if that's for regular military. If the borrower is a reserve or a National Guard member, the mortgage insurance is, higher. I believe that is 2.48 or 2.4 for National Guard or reserve.
So is this just a fee like points that you'd be paying? Or how does that work?
It's a fee. It's treated very much like the FHA upfront mortgage insurance premium. It's financed into the cost of the loan. So you are able to, that gets rolled right into the loan itself.
Okay. So then we've got, tell me, what's a USDA loan?
The USDA loan is a housing and rural development loan. Those are for developing the rural areas of the state. Very similarly, there's 0% down with that loan program, and they do have a guarantee fee, is what they call it. So with the USDA, the guarantee fee is 2.5%. I apologize, that's 2%, and they also have a monthly mortgage insurance of 0.5%.
Okay, and what kind of a score do you need in order to get this?
With USDA, it's a minimum FICO score of 620.
Okay. Now, as I think, can we get this anywhere? Or do we have to be in certain places?
So it's definitely certain areas of the state. There are, rural areas. USDA has a great link right off their website, property eligibility. You can type in the address right there, and it'll tell you if it's eligible for USDA funding.
Okay. Let's see. We've got another question from Siobhan that we'll get to in a moment. Let me see. What is a CONV loan?
CONV is abbreviation for conventional.
Oh,
So that's your conventional financing.
Okay. And home ready.
So home ready is a variation of a conventional loan. Two loan programs which are almost identical. Home ready, which is Fannie Mae's version, and then Home Possible, which is Freddie Mac's version of the program. It does have reduced mortgage insurance. With a regular conventional loan, 3% down, that would be subject to 35% coverage. With both Home Ready and Home Possible, that's reduced to 25% coverage. You also get a lower interest rate.
Oh, okay.
Go ahead.
Yeah, so each of these loans has a different amount of minimum, or it's I guess all the ones we've talked about have been between 0 and 3.5%. If they're putting down 20%, does that make it easier for them to get the loan?
In terms of making it easier, I wouldn't necessarily say it makes it easier. Really, the big difference when you talk about putting 3% down or 20% down is there's no mortgage insurance when you're putting 20% down. So that's kind of the hump you're trying to get over, if you will, if you're really trying to avoid paying the mortgage insurance.
Okay, so what it's going to mean is, since the mortgage insurance is on top of your payment every month, that means that your payments will be lower if you do 20%, significant, maybe a lot lower if you do 20% than if you do 19%, because you're just.
I wouldn't say that. Yeah, I wouldn't say necessarily significantly lower. If you put 19% down, you're 81% loan to value. The mortgage insurance that would be subject to that loan is very minimal. The coverage factor, is very minimal, because we're really just trying to. It would be on there for a very short amount of time. You're probably only looking at 2 years or less, putting that kind of money down. But it would definitely be lower. It would not be subject to that mortgage insurance. Even for that short amount of time, if you were to put the extra 1% down and go 20% down.
Okay. So our Siobhan has a couple of questions. Are Home Ready and Home Path only for first-time buyers?
So Home Ready and Home Possible are not only for first-time home buyers. They do require a home buyer education course, which you can take right through their website, but those are available to anyone. I would say the only caveats with the Home Possible and Home Ready loans are that there are income restrictions. And those income restrictions are different based on the area code that you live in the address.
Oh, okay. So if somebody lived in Westport, it might be a different income restriction than if somebody lived in Bridgeport.
Certainly. Yep.
Okay. All right. And Siobhan also, who's in Stratford, she wants to know, could you run through an example of out-of-pocket cost and approximately monthly payment for both FHA and conventional 3% on a $150,000 house? Have you got your calculator handy, Matt?
I will certainly do that if you give me a few minutes.
Okay. Do you want me to talk while you're doing it, or did you just bring this up on the computer and?
I'll pop it up on the computer and run a quick scenario for you.
Okay, great. So do you want me to talk without you, and you'll come back, or you can multitask?
I'm pretty good at multitasking, so let's try it, and we'll see how it goes.
Okay, great. Let's see. So, as I was saying before, if you're watching, give me a like. Let me know where you're from, just so we know that there's actually somebody watching. If you're watching it on the replay, please let me know. Say hello, say hi, say I was here, say I'm calling from Oshkosh or watching in Oshkosh or wherever you are. I guess the other question that I asked before, and you can type your answer and we can talk about it, is what else would you like to see? Now we're thinking what we're looking at in the future is talking to a home inspector. We're thinking about interviewing a public insurance adjuster. And not a lot of people use them, but if you're involved in real estate and you have a loss, a public insurance adjuster might be the person that you want to call even before your insurance company. Okay, go. Your turn. Go right ahead, Matt.
All right. So in terms of, out-of-pocket costs, I guess what I'll focus on, the two items that we mainly focus on are down payment and closing costs. Down payment is a direct derivative of the purchase price. So if we're looking at a purchase price of $150,000, if we're putting 3.5% down, we're putting $5,250 down. If we're only putting 3% down, that's a flat $5,000. So that would be the down payment. Obviously, down is funds you're putting down. So you're offsetting the purchase price of $150. If we're putting $5,000 down, we're only borrowing. I shouldn't say ballpark, but for me to give you an exact estimate of what it would be, I would say, the two main things that drive your closing costs obviously will be the purchase price, and then also you have setting up those escrow accounts. So when we're talking about putting 3% down and 3.5% down, we do have to escrow for taxes and insurance, meaning those will be automatically included in your monthly mortgage payment. So we have to set up those accounts, fund them so that the mortgage servicer, the lender, can make those payments on your behalf when they come due. So I would say, conservatively on 150,000, we're putting 3% or 3.5% down. With origination fees, closing costs, in terms of attorney's fees, owners and lenders, title insurance premiums, if you kind of budget for 10%, that would certainly be on the high side. I would estimate probably on a scenario like that, you're probably looking at, between $7,000, maybe $8,000 in closing costs. And like I said, the big ticket items there are setting up your escrow accounts for taxes and insurance. So if you're looking at, insurance of $400 a month on purchases, we typically escrow or collect 8 months of taxes at closing. And the reason being, the majority of the towns in the state of Connecticut, tax bills are due January and July. You split 12 months down the middle. That's where we come up with a 6 plus a 2-month cushion kept in the account in the instance that taxes do go up. That way you have a little bit of a buffer there to cover that. Also, homeowners insurance. At closing, you would pay for 1 full year of your homeowner's insurance, and then we would escrow a 3-month cushion for that. So basically, the next 12 subsequent months, you pay into that account. So 12 months from the closing, when the next homeowner's insurance premium is due, we have sufficient funds in there to pay the homeowner's insurance premium and also that 3-month cushion in case the homeowner's insurance does go up.
Now, we can roll some of our closing costs into that loan, right?
In terms of closing costs, with an FHA versus a conventional loan, closing costs will differ very slightly. I would say, the big two differences there is when you look at, what we refer to in this business, both on the realtor and the lending side, are seller credits. With a conventional loan, we can get a seller credit of a max of 3%. So the seller can cover 3% of the total purchase price in closing costs. With an FHA loan, we can go up to 6% there.
Okay, now Siobhan also wants to know.
So depending on disposable cash that the borrower has, one reason why you may look at an FHA loan versus a conventional loan is, if the borrower has enough money to cover their down payment, their 3.5% or their 3%, depending on whether we're FHA or conventional, but not much money outside of that, we might need to go in an FHA loan to get a full 6% coverage to cover that.
Okay. So let's go to a question from Steve. Steve asks, I'm interested in buying a rental property in Connecticut. What's your criteria? Income?
Ed, can you hear me?
Yeah, I can hear you. Can you hear me? Okay, looks like we lost we lost Matt again. Oh, here he is. Let me pull him back up. All right, we're back. All right.
Sorry about that. Where did I leave off?
You got through everything, and then I was about to talk about Steve Levy's question, and you kind of disappeared. So Steve wants to know, he says he's interested in buying a rental property in Connecticut. What is your criteria for income, debt to income ratio, etc., for approving investor loans? And can I qualify based solely on expected rental income?
So, Steve, in terms of investment properties, rental properties, I guess it would vary depending on whether you're looking at a single family, a two family, or a 3 to 4 family house would really be there.
So is it's easier to buy a 3 or 4 family than a 1 or 2?
No, I wouldn't say easier or harder. It really, that's where down payment comes into play. If you're looking to buy a single unit home as an investment property, you only need 15% down with a conventional loan. If you were looking to buy a 2 to 4 family, now we're talking about putting 25% down.
Okay, and how would you qualify him as far as income? Could he use all the income from the rental property to qualify, or would he have to have other income?
You can use a percentage of the rental income to qualify. If you have absolutely no debt, in theory, the rental income we have to have employment. We have to verify employment. In the debt to income ratios, for a conventional loan, we can go up to a max of 50%. So if we would need other income in addition to the rental income for qualifying.
Okay, so you don't do no-doc loans for those?
No.
Okay, and we're talking 1 to 4 family. You guys don't do commercial loans for commercial buildings, which is typically something they call a commercial building more than 4?
Sure. Yes. At this time, we're not doing any commercial lending. We're strictly focusing on the residential.
Okay. So Siobhan wants to know, if you have an FHA, can you also have a
Impossible.
Home possible loan? And I guess so would one, I'm not sure if she means one of them would be a second mortgage or not. I guess
sure. Sure.
You can have a second mortgage. Have you used one of those as a second mortgage?
No. So I think what Siobhan's referring to, Siobhan, correct me if I'm wrong. I guess you own an existing home that might have an FHA mortgage to get a home possible loan. Which, yes, that is acceptable. So the FHA loan is an FHA loan. The home possible is a conventional loan, so there are no issues there.
Okay, and
you typically would run into an issue where you have an existing FHA mortgage, and then you would try to get a second FHA mortgage. That's really the only time that would become an issue.
Okay,
and not to say that it's never allowable. Let's say, for example, you bought your first home. In Connecticut, a single family home, 2-bedroom, and then now all of a sudden you're being relocated to Massachusetts, and you've since been married and you have 3 kids. So clearly you've outgrown your existing home, and now also you're being relocated for work. There are certain circumstances that would qualify for you to hold 2 FHA mortgages.
Okay, great. And Steve wants to know, I'm self-employed. Is that a problem? So what would you need from a self-employed person to get one of these loans?
So for a self-employed person, we're going to look at a 2-year history. 2 years self-employment. We would collect 2 years of tax returns, depending on how they file. If they do have business returns, K-1s, we would need to look at documentation like that. But really, for the most part, we would take a 2-year average of the self-employed income and qualify them based off of that.
Okay, and if you just came on, this is Ed Weinberg. This is CTRE Investors, and you can find replays of this on Facebook Live afterwards, and also on our site, ctreinvestors.com. Another way to hear about us is to go to the CTRE Investors on Meetup. Okay, if anybody, I see we've got somebody new who just joined us. If you can give me a like and tell me where you're from, give us just a little note saying where you're from, that would be great, or a like. And I'm just checking, does anybody else have any questions? If not, we'll wrap things up. All right. So this has been, I'm Ed Weinberg. This is we're at CTRE Investors, and we did have on Matt Kelleher. Matt is from RMS, which is Residential Mortgage Services. Matt. Do you want to give you want to tell him where your place is and give a telephone number?
Sure. And Ed, if you don't mind, a little further on some products. So with the FHA loan, FHA is geared toward primary residence. So we're assuming that the buyer is occupying the property. So with FHA, if you're looking to buy a 3 to 4 family home, you can still put your 3.5% down. You would not be required to put 25% down with a program like that. And one of the benefits with FHA is you can use up to 75% of the rental income for qualifying. So on a 3 to 4 family home, obviously, you would occupy one of the units. We would then be able to use the rental income from the other units, 75% of that for qualifying. So, just because you don't have 25% down to put on a quote investment property doesn't mean that there's no way to get that, with less money. As long as you plan to occupy the property as your primary residence, you could use an FHA loan, to get into that property for 3.5% down. And then outside of that, I would say the only loan we really didn't touch on is the CHFA loan, Connecticut Housing Finance Authority. They're very similar state housing programs with Mass Housing, and same with Rhode Island. And really with those programs, very similar, although there's always an added benefit. With conventional, it's a very similar loan program to the Home Possible, Home Ready loans, except they have even further reduced the most competitive interest, or some of the most competitive interest rates. And they even take it a step further, where if the borrower is paying a point, they get a further reduced interest rate, which definitely outcompetes the market. And then even beyond that, they have reduced mortgage insurance. So let's take that same 3% down loan with Home Possible. It would be 3% down with Home Possible. You have mortgage insurance coverage of 25%, and with the Connecticut Housing Finance Authority, that would be reduced further to 18%. So very competitive product. They also offer a Connecticut Housing Finance Authority FHA. Follows same guidelines, same everything with the regular FHA loan. But like I said, you do get that benefit of reduced interest rate with the Connecticut Housing Finance Authority. They also have USDA, all sorts of different loans under the Connecticut Housing Finance Authority umbrella.
Okay.
Outside of that,
how do we find you? Steve wants to know how do you contact Matt?
Sure, Steve. I'm available anytime. I'm located here in Southington. My office is 26 North Main Street here in Southington, Connecticut, 06489. Feel free to call me, 860-302-2934. You can text me. And if your email address is Matthew, MATTHEW .kelleher, KELLEHER @R as in Roger, M as in Mary, S as in Sam, mortgage.com.
Okay, great. So thanks for joining us, Matt. And again, what's that?
Thank you for having me.
Okay, you're welcome. And again, this is Ed Weinberg. I'm with CTRE Investors, and we meet here typically on the first and third Thursday at 7 p.m. If you're watching on the replay, please give me a like, and we'll see you next time. Everyone, have a great day.